They really struck Iranian nuclear facilities. Those electrifying words instantly ricocheted through brokerage chat rooms, news feeds, and every social media thread frequented by traders who spend their weekends scanning for any hint of market-shaking events. This abrupt development left seasoned analysts wide-eyed. How would a swift escalation between the United States and Iran reshape global indices like the S&P 500 and the Nasdaq 100? And more importantly, would the price of crude oil skyrocket once markets reopened, setting off chain reactions in energy stocks, defense contractors, and even travel companies? Today we will untangle exactly why this strike has the potential to rewrite Monday's market script and explore the high-stakes calculations swirling around. In this episode, prepare to discover the backstory behind rising geopolitical pressures, an in-depth look at oil's potential to leap toward $90 per barrel, and how major banks had already foretold these dramatic swings. We will also examine whether big players like energy titans and defense conglomerates will gain a massive advantage while travel-focused names brace for turbulence. Finally, we will evaluate if this crisis could remain contained and what it might mean for your portfolio in the weeks ahead. So, do not miss a single word. Now, let us set the stage with the moment that set every phone buzzing. News of United States strikes on Iranian nuclear facilities, delivered on an otherwise quiet Saturday. No matter how often we have seen geopolitical flare-ups, there is always a jolt when a global superpower takes direct military action. Experts had cautioned that a confrontation was growing more likely, yet many still considered an immediate escalation improbable. Then it happened overnight, as if out of the blue, forcing hedge funds, retail investors, and large institutions alike to confront the impact first thing Sunday evening when futures markets would finally open. Why does this matter so dramatically for the S&P 500 and the Nasdaq 100? Because these broad market benchmarks reflect collective sentiment, pricing in everything from consumer optimism to corporate earnings forecasts. When news so starkly disrupts global assumptions, futures markets can react with huge leaps or dives. In this situation, the United States targeting Iran's nuclear facilities implies a host of serious outcomes, from skyrocketing oil prices to ripples across defense stocks. Analysts at major investment firms have long maintained a watchful eye on Middle East tensions, but this was precisely the kind of event no one wanted to see materialize. In this deep dive, we are going to examine 5 crucial points. First, how oil supply disruption could push Brent crude prices to near historic highs. Second, why institutional data from Morgan Stanley, Goldman Sachs, and other powerhouses predicts distinct winners and losers among different sectors. Third, what the likely moves in defense, energy, and tech shares might look like. Fourth, how the Strait of Hormuz remains an all-important choke point that could either tighten or let the world breathe easy. And fifth, how markets might behave if the next steps from Iran escalate or stay restrained. And if you are enjoying these insights so far, consider showing some support right now. A quick thumbs up or like goes a long way in letting us know you appreciate the depth we bring here. Let us peek behind the curtains of the institutional perspective. Many analysts had quietly flagged this scenario as unlikely yet plausible. If hostilities flared, oil prices could lurch higher. In fact, Goldman Sachs previously posited a $10 per barrel geopolitical premium on Brent crude precisely because of swirling tensions in the region. They reasoned that if Iranian exports, which stand around 3.3 million barrels per day, were at risk, the market would scramble to reassess supply. Even a 1 million barrel per day drop, some argued, might yank the center of gravity for crude closer to $90 per barrel. Before the strikes, this was a theoretical scenario. But with the United States taking direct action, what was once a mere forecasting model may well become reality. There is also a historical lens that large institutions rely on, a tapestry of past events in which oil producers faced regime shifts or sudden disruptions. Recall Libya in 2011, when the toppling of Muammar Gaddafi halted significant output, leading to a major run-up in prices. Or cast your memory further back to the Iranian Revolution in 1979, which hammered global supplies and triggered a massive oil shock. While circumstances differ each time, the data from these episodes suggests a consistent theme. Markets hate uncertainty, and when a key oil exporter steps into a fray, volatility flourishes, often to the upside. Let us dive into how quickly prices can swing. Brent crude is already a focal point for traders worldwide, but in a tense moment, it acts almost like a barometer of fear. The difference is that an uptick in Brent oil can also rattle the foundation of global travel, manufacturing, and consumer sentiment. That is because when energy costs spike, airlines face larger fuel bills while shipping companies grapple with higher transport expenses. As a result, we would expect carriers like United and Delta to weigh the possibility of scaled-back travel for budget-conscious passengers. Similarly, bookings at major travel platforms might take a hit, since the fear of regional conflict often curbs people's desire to jet-set. This potential for disruption is not limited to the travel industry. Many major indexes also contain technology juggernauts that hinge on stable consumer sentiment and minimal supply chain friction. If the threat of conflict expands, leading to surging fuel spending or new shipping difficulties, big tech might see a short-term slump. Why? Because uncertain times frequently prompt investors to pull money out of the more aggressive growth sectors and redirect it toward defensive names. And one cannot get more defensive than the actual defense sector. There sits an entire cluster of companies that stand to gain from heightened geopolitical unease. Lockheed Martin, RTX, Northrop Grumman, and L3 Harris exist at the intersection of advanced weaponry and government contracts, which historically see increased funding whenever tensions turn hot. Indeed, analysts love to cite previous episodes in which Middle East crises boosted defense stocks by tens of billions of dollars. When fear runs high and lawmakers vow to strengthen deterrence, these firms often enjoy a sudden surge in share price. They also hold the promise of relatively stable contracts, because national defense is the last place many governments cut corners. This does not mean that the entire market is on a path to gloom and doom. Quite the contrary. While a dramatic event can cause broad selling early on, it also may funnel capital towards safe havens. That is why we often see the VIX, known as the fear index, spike into the high teens or 20s during these stress points, handing nimble traders short-term opportunities. Speaking of fear indexes and safe havens, gold and treasury futures tend to attract interest the moment immediate tensions escalate. The logic is straightforward. If equities look precarious, there is typically an exodus into assets that could maintain value in times of crisis. Gold is the classic store of wealth that retakes center stage whenever people worry about inflation or military conflict, or both. Meanwhile, treasury futures become a magnet for those seeking stability from the world's biggest economy. One might see government bond yields dip as prices rise, because in jittery moments, investors find a certain measure of comfort in United States-backed securities, no matter the current chatter about interest rates. Yet we should avoid concluding that these strikes trigger an inevitable meltdown for all stocks. Some big names at major brokerages have pointed out the possibility of a small correction in worldwide equities, perhaps in the 5 to 7% range. Michael Wilson of Morgan Stanley, for instance, recently noted that a flare-up of this type can knock the market off course, but does not necessarily stifle existing fundamentals, especially if corporate earnings remain robust. In plain English, that means that if the conflict does not escalate further, and if supply chain disruptions stay modest, the overall impact might be contained. To see why, let us recall what underpins the S&P 500 and the Nasdaq 100. Amid the swirling storm of tension, the broader United States economy remains resilient, with some tech stocks continuing to post enviable profits and growth. Meanwhile, consumer spending might not collapse overnight just because of 1 or 2 days of news, provided the conflict stays contained. In short, we should brace for short-term volatility, but not necessarily a meltdown, unless the friction morphs into a long, drawn-out standoff. However, you might ask, what about the Strait of Hormuz? The name alone often conjures images of potential blockades and tensions. For this narrow passage accounts for a large chunk of global oil traffic, around 1/5 of worldwide seaborne petroleum shipments. Naval presence from the United States and other allies in the region might deter total blockades, but all it takes is a single major incident for shipping insurers to rocket their rates, for tankers to move more cautiously, and for oil markets to gyrate. If that hurdle comes into play, the price of crude could climb dramatically, intensifying the sector-by-sector shakeup we have been describing. Let us break down how this scenario might evolve. If no further retaliation emerges, some portion of the trade is likely buy the rumor, sell the news, meaning that after a few dramatic sessions, markets might regain calm. Energy producers such as Chevron, Diamondback, Marathon Petroleum, and APA Corporation could see their stock values elevated by the resulting oil jump. Defense contractors remain well-positioned, as increased tensions could nudge government spending in their direction. Meanwhile, airlines, travel platforms, and perhaps certain consumer-oriented tech names may exhibit weakness, weighed down by the specter of rising costs, reduced consumer appetites for leisure, and general market anxiety. In summary, it boils down to whether the Iranian response remains symbolic or, in the worst-case scenario, escalates into something that directly disrupts the enormous flow of oil or shipping. If that disruption does occur, the entire global supply chain must adjust swiftly, potentially sending shockwaves across multiple industries. But if cooler heads prevail and no major Iranian counteraction materializes, institutional consensus points to a contained equity dip. Painful for some sectors, beneficial for others, yet not necessarily a meltdown if fundamentals hold steady. By fundamentals, we mean corporate earnings, job growth, and consumer confidence in places like the United States and across key international markets. Another angle worth exploring is how the Federal Reserve might respond if higher oil prices start feeding broader inflation. However, with central banks typically forward-looking, they might hesitate to change monetary policy just on near-term jitters. Instead, they could look for sustained inflationary pressure in wages and goods before adjusting rates. In other words, the Fed might see these strikes and ask whether they produce only a short bump in prices or a lasting shock to supply. If ephemeral, rate policy could remain relatively unaffected, letting fundamentals continue to drive equity performance. Moreover, we should remember that markets are a fluid ecosystem. Even when a shock hits, numerous participants are eager to exploit sudden mispricing, which can smooth out the extremes. For example, if tech stocks dive too low because investors fear an extended conflict, bargain hunters may jump on the opportunity, contributing to a partial rebound. Likewise, in the energy sector, if oil leaps too high on speculation of a full blockade, sellers might step in if evidence arises that shipping lanes will remain protected by naval forces. Yet for the time being, everyone is bracing for the opening bell. Sunday night futures trading becomes the early battleground for these tensions, with countless eyes tracking the price of Brent and West Texas Intermediate crude. If the opening prints show a gap up of several percentage points, that is a clear sign of heightened alarm from the market. Then, come Monday morning, the S&P 500 and the Nasdaq 100 could open notably lower, fulfilling predictions by some that these indexes might drop nearly 1% or so at the outset. If that scenario materializes, it is only the beginning of the actual drama, because the volume of trades on Monday can expand volatility further. Of particular interest is how swiftly large investors respond if the initial dip is more frightening than expected. Pension funds with protective puts in place might choose to exercise them. Hedge funds that had set up short positions in the face of potential instability could cash out. Meanwhile, certain risk managers may want to buy more portfolio insurance if they think the dust has far from settled. That is precisely why you might see the VIX, a measure of anticipated volatility, rocket above its usual teenage levels into the realm of 20. The shape of the volatility curve might flip into backwardation, suggesting that traders are paying more for short-dated protection than for longer maturities. Now, as for the Iranian perspective, the market wants to see if there will be retaliation, either official or through proxy groups in the region. The possibility of sabotage, infiltration, or direct confrontation always looms in any conflict scenario. Analysts caution that if Tehran views the strikes as an existential threat, the potential for a retaliatory move increases. That in turn could risk damage to infrastructure, shipping routes, or other sensitive targets. On the other hand, if leaders in Iran decide to minimize risk, the response might be largely rhetorical, seeking only to galvanize domestic support without risking direct conflict with the United States. In such a case, tensions could remain high on headlines, but not necessarily boil over. Defense specialists and intelligence analysts caution that it is not just about official militaries. Non-state actors in the region can disrupt assets as well. When that happens, insurance premiums mount, shipping becomes more cautious, and markets brace for an extended cycle of unpredictability. However, the United States maintains a significant naval presence near the Strait of Hormuz, which acts as a deterrent and logistical support for continued safe passage. That might prevent a full-scale blockade and calm the worst fears about a global oil crisis. Given these swirling possibilities, we can see how crucial it is to follow the developments in the first few days after the strikes. If you want to stay updated as we continue to monitor the aftershocks in oil prices and watch how the S&P 500 and Nasdaq 100 respond, consider subscribing or following our ongoing coverage. We will keep diving deep to give you a thorough perspective on the shifting market narrative, so you do not miss any critical moves. Ultimately, the reason this saga matters is that it touches so many vulnerable spots in the global system. The energy sector's capacity to take a price shock, the travel industry's sensitivity to sudden conflicts, the defense world's ability to seize government contracts, and the broader market's appetite for risk. When these puzzle pieces shift, the average investor has to weigh whether short-term fear might overshadow the stable backdrop of strong earnings and economic growth, or whether this event is the first domino in a chain of truly seismic changes. Sometimes such escalations fizzle out quickly in financial terms, overshadowed by bigger stories, but other times they become black swan events that reshape entire sectors. Certainly, the next few weeks might tell the story. If demand for crude remains solid and Iranian supply is sidelined or threatened, Brent could rally to that near $90 threshold. That level, as flagged by various analysts, is more than just a round number. It can signal that a new era of higher price floors is upon us. Even a short-lived supply disruption might leave lasting psychological impacts, especially if major players suddenly realize that Iranian exports are more vulnerable than previously thought. Still, domestic oil production in the United States combined with possible incremental supply from other OPEC+ countries, if they wish to step up, could soften the blow. But that is a big if, because OPEC+ has not always responded quickly to changing conditions, and spare capacity might be insufficient to offset a dramatic drop in Iranian exports. Meanwhile, international watchers wonder how China, India, and other major importers of Iranian crude might adapt to potential shortfalls if the tensions escalate. On balance, let us not forget that the world has become somewhat numb to one-off strikes and threats that do not immediately spill over into everyday life. Hence, if the event remains localized without major punitive measures from Iran, markets could see a flurry of fear that tapers by mid-week. The biggest winners, if that occurs, would likely be short-term energy speculators, long positions in major defense contractors, and a handful of contrarian investors who interpret the dip in broader equities as an overreaction. On the losing side, we may see a wave of caution for the travel industry, given that higher fuel prices usually eat into profits, and risk-off sentiment can dissuade folks from booking flights. Where does this leave us? The absolute key variable remains Iranian retaliation. If nothing serious emerges, the S&P 500 and Nasdaq 100 might quickly factor in a small risk premium and then normal trading resumes. But if an orchestrated push in the Strait of Hormuz or direct attacks occur, the drama could unfold in shocking ways. The window of unpredictability is typically greatest in the first few days after a surprise military strike. Amid all this is a question: is the world on the brink of forming new alliances or dividing lines over these events? International politics can shift swiftly under the pressure of sudden conflict, and if allies pick sides or impose sanctions, that can expand the economic ramifications beyond just a short oil shock. For now, leading banks and forecasting units keep referencing their historical models, but we all know that real events rarely stay neatly inside those lines. Ultimately, markets are emotional creatures, swayed not only by supply-demand equations, but also by raw sentiment, fear, and hope. That is why Monday's open will be so captivating. It will show us how swiftly traders will price this new reality. Whether it sends the VIX into the 20s, lifts Brent crude to new short-term highs, or triggers a modest correction, we will learn a lot about the market's overall risk tolerance. Conscientious investors will be keeping an eye on price movements in defense and energy names, from Lockheed Martin to Chevron, as potential barometers for how seriously the street views this confrontation. Many analysts agree that if the drama does not worsen, the overall correction might be a quick jolt rather than a meltdown. Yet, watch out if more explosive news emerges that would shatter any illusions of containment. Remember that in global markets anything can happen, and often the biggest moves come from the second wave of announcements, once the initial shock fades and cooler minds realize the deeper implications of a crisis. Still, if the global economy and corporate earnings keep humming, a measured approach may serve us best in the weeks to come. That said, do not let your guard down. Keep your eyes on the headlines and the shipping routes, because in times like these, the smallest catalyst can unleash massive change. As traders shuffle back to their desks for the week, the emotional pendulum might swing from dread to calm, or from calm to absolute frenzy, all depending on any new developments out of Tehran or Washington. We can expect the headlines to revolve around whether the Iranian government vows revenge or simply issues stern warnings. We should also keep tabs on how the rest of the Middle East reacts, because alliances can be fragile, and a poorly timed statement from a key regional player could raise global concerns in a blink. In conclusion, while the markets may appear fragile in the face of a dust-up like this, never underestimate their resilience. If the conflict remains short-lived, we might see a surge in defense and energy names, a brief dip in broader equities, and then a reset. If you found this breakdown illuminating, share it forward or drop a comment, letting us know which factor most intrigues you. Your engagement underscores how crucial it is that we keep these dialogues flowing, ensuring every angle is examined and no risk is left unexplored. Remember, we are all part of this grand experiment called the global economy, where one strike can shape the fate of countless investments. And that is our extended deep dive into the unfolding aftermath of the United States strikes on Iranian nuclear facilities. We have charted potential winners, potential losers, historical precedents, and the data-driving decisions at major banks. As we watch for retaliation, keep your emotions in check. Tension will likely be high, but we have been here before in different forms. Markets adapt, and so do we. Whether that means a quick bounce or a drawn-out saga, time will tell. So, stay tuned, stay sharp, and be ready to adjust your strategies as the story evolves day by day. That is it for now. Keep your seatbelts fastened, because the coming sessions promise a suspenseful ride.